podcast with our host, Ed Lyon. Ed, how are you? And oh my goodness, you have a topic. You had to hit me with one today, didn't you?
I'm doing great, and we're going to have fun. It's going to be a fun topic, and I think a lot of people are going to walk away surprised, maybe a little puzzled, but surprised.
So you told me when we're in the green room, you have going to touch a live wire today. What's going on?
So I love to have conversations about whatever is going on in the country or the world. Nobody wants to start a topic about or start a conversation about taxes. They're already talking about something else. So if I can slide into the conversation that people are already having, then they're going to be more receptive to what it is I have to say. And so today we're going to talk about Epstein. So Jeffrey Epstein, of course, has always been in the news. And it's just a matter of degrees. It's just he's always waiting in the wings, and there's always Epstein news about there. But as we record this podcast in early August, he is more in the news, and the Senate or the House Oversight Committee has subpoenaed documents, and the White House is considering releasing a transcript of the interview that the Assistant Attorney General had with Ghislaine Maxwell, and we got a lot of Epstein news. So there's new news specifically on the tax side that we're going to discuss, and Senator Ron Wyden is the Democratic senator from Oregon and the ranking member of the Senate Finance Committee. So he wrote a letter dated July 31st to the new Internal Revenue Service Commissioner, who's only been in his position since June. So he has inherited this mess. This has nothing to do with the current IRS. But I'm going to read the first paragraph of this letter, and then we'll talk about it.
Okay.
So Senator Wyden says, "Dear Commissioner Long, I write regarding the failure of the Internal Revenue Service to audit or investigate suspicious transactions involving alleged tax planning work performed by Jeffrey Epstein. Epstein was paid hundreds of millions of dollars between 2012 to 2017 for purported tax solutions, money that government authorities stated was used to fund Epstein's sex trafficking operation. Epstein lacked any professional training or certification in accounting or tax law, yet was chosen by very wealthy people to execute very complex tax-related financial transactions. Despite this glaring lack of qualifications that might lead anyone to double-check Epstein's work, it appears that the IRS failed over the course of many years to audit major tax transactions involving Epstein. In fact, an investigation by my Finance Committee staff has confirmed that certain highly complicated tax arrangements between Epstein and one of his billionaire funders have never been audited by the IRS." That sounds like pretty evil stuff, right? Sounds like a lot of skullduggery going on. And we love skullduggery in Washington, right? But what I want to do is walk through this claim and debunk some of the sensationalism in this letter and talk about whether a guy like Epstein, who didn't have any formal tax or legal training, might or might not be qualified tax advice. So let's start with that question. When you think of the word taxes, you probably immediately think of CPA, right? Because CPAs do taxes. You have a CPA or an enrolled agent who does your tax returns, and you think of somebody who sits through 4 years of classes on debits and credits and balance sheets balancing and all that sort of stuff. Now, Epstein didn't do taxes for people. He didn't prepare tax returns. He didn't prepare legal documents. He didn't prepare trust documents. He didn't do anything like that. And so Wyden is saying that Epstein is getting involved in these very complicated transactions, and the IRS didn't do any auditing. So the implication is that, oh, there's a scandal here. The IRS didn't audit what Epstein did. But is there really a scandal? So first of all, lots of people give tax advice. Lots of people work with taxes who don't have an accounting degree, who don't have a law degree. Most financial advisors get involved in their client's tax picture, whether they're managing a portfolio for tax efficiency, whether they're selling life insurance, which offers tax-free income, whether they're helping with estate planning planning, whether they're helping a client manage his overall portfolio. So companies like Merrill Lynch and JP Morgan have thousands of financial advisors across the country who are helping their clients pay less tax and who don't have any formal tax training. This is not scandalous. This is just the ordinary course of business. You've probably bought a house and you may have discussed when the tax deduction kicks in with your mortgage broker, right? You have tax discussions with other business advisors, people helping you manage your business, and they're not necessarily credentialed in tax. So that's the first point to understand about this Epstein letter, is that just because somebody doesn't have the initials JD or CPA or EA after their name doesn't mean they don't have something valid to say about tax planning. So, second question is, should the IRS be auditing these complicated transactions? The IRS doesn't audit really much of anything. They just don't have the resources. IRS gets 240 million tax returns a year, and that's individual income tax returns, partnerships, S corporations, C corporations, trusts, estates, payroll returns. And the IRS processes all of these things. Everything goes into their computer. And if the IRS finds that there is a reason to audit, they will do that. But the IRS gets way too much to audit. So the mere fact that none of these transactions were audited, that's not a reason to be suspicious. And I understand that in this letter, Senator asking the question, should we be worried that the IRS years ago didn't audit these transactions from 2012 to 2017? The response is the IRS rarely audits anything. They just don't have the resources to do that. And in fact, a big part of what the new IRS commissioner is looking to do is move the IRS from a system of enforcement by people auditing returns to a system of enforcement by technology, using AI to identify audit targets, right? So the fact that they weren't audited is not suspicious, and to a professional reading this letter is not going to raise any suspicion. Next question, is Epstein a tax cheat? Yeah, and it would be hard to believe that a guy who's done everything that Epstein has done would also be a tax cheat. Hard to believe. Nobody is accusing Epstein of being a tax cheat here. What the senator is asking is, did the IRS look at these transactions on behalf of a specific client, a guy named Lyon Black, who is a multi-billionaire, founder of Apollo Capital Management, who has since stepped down from that position because of the controversy over his relationship with Jeffrey Epstein. But this isn't even an income tax question. So Epstein did not give income tax planning advice in this case. Epstein gave advice on a specific estate planning strategy called a Grantor Retained Annuity Trust. And lawyers and CPAs love to come up with complicated names for these programs. I'm not going to get into the weeds on what a Grantor Retained Annuity Trust does, but it basically lets you take an asset, put it into a trust, and then give the appreciation on the asset to somebody else, to typically your children and grandchildren. Neil, you've got a house in Mentor, Ohio, and let's say that house is worth $300,000. And you're going to live there 10 years and you want the value of the house to double to $600,000. I know our listeners in places like California are laughing at us. Here in Ohio, where we live, you can get a house for $300,000. So let's say you wanted to keep the house, but you wanted to give the appreciation to your children. Well, a Grantor Retained Annuity Trust lets you take an asset, put it in the trust, get an income from the asset during your lifetime, and give away the appreciation, and it won't be taxable. So it won't create taxable income. You don't have to pay income tax. Your kids don't have to pay income tax. It also doesn't add to the value of your taxable estate. So it is a value discount strategy. It's a pretty typical strategy. Now, we'll talk in a few minutes about the suspicious aspect of this. But a Grantor Retained Annuity Trust is a pretty straightforward estate planning strategy. Lyon Black did not do this himself. Jeffrey Epstein didn't draft the documents. Black went to a very well-respected white shoe law called Paul Weiss. And Paul Weiss's lawyers, who are literally at the top of their profession and not likely to be engaged in any skullduggery, drafted the actual trust documents for Lyon Black. Do you see any crime yet?
No, nothing. I don't see a crime at all. And I don't understand. I just think you're going to look at everything else that went wrong and say, no, guess he did everything else wrong. He's guilty here.
Because it's right. The implication is because Jeffrey Epstein was a monster and did all of these monstrous things, Senator Wyden is asking the question, should the IRS have looked to see if there were monstrous things going on in this tax arena? Was the IRS negligent in not looking to see if monstrous things were going on in the tax arena? And so far, the answer is no. We're answering that question. Was Jeffrey Epstein illegitimately giving tax advice? I would say no, because lots of people with no formal tax training do help their clients with tax planning strategies. Was this the kind of strategy that should be audited? And in his letter, Wyden says nobody double-checked Epstein's work. How does he put it? Despite this glaring lack of qualifications that might lead anyone to double-check Epstein's work, it appears that the IRS failed over the course of many years to audit major tax transactions involving Epstein. Epstein wasn't the client. These were not tax transactions involving Epstein's money. These were tax transactions involving Lyon Black's money. And in fact, the work was double-checked by the lawyers at Paul Weiss, who drafted the trusts and created these arrangements. So far, it's much ado about nothing. Now, where we do get into a potential issue, and I think this is where Wyden is really focusing his efforts, Epstein charged fees. I believe the total was something like $157 million in fees to save $1 billion in estate tax. Now, that is a really high fee. I have never charged $157 million in a tax planning fee. I can only hope that and I have billionaire clients, and I charge nowhere near that amount in fees. So that is a really high fee. Arguably, it's a pretty reasonable fee to save $1 billion in estate tax. If I had the chance, so I live in Cincinnati, Ohio, I could walk down the street to the Hard Rock Casino. If you told me I could take $157 million to that casino and I'd walk out $1 billion, Neil, I would do it every day. Some days I would do it in the morning, grab lunch at the steakhouse, and go back and do it again, just because that's the kind of guy I am. So it's a real value. Now, you might say, would any other tax planner charge $157 million in fees? Did the law firm of Paul Weiss charge $157 million in fees? And the answer to that is no. That is a very high fee. So could the fee be a cover for something else? That's where we're really getting into quicksand. And then the final point that Senator Wyden made in the letter was that there was no written fee agreement between Epstein and Black. I'm pretty sure that if somebody is going to pay me a $157 million fee or even a $157,000 fee, they're going to want to have a written agreement. So when I do tax planning for my high net worth clients, my high income clients, I will have a written letter of engagement that both of us will sign. It will set out the scope of my work. It will tell them what areas of their taxes I'm going to be looking at. And when I do a tax plan, I give a written guarantee that if I don't reach a certain level of savings, I will refund the client a percentage of the fee equal to whatever percentage of the savings I miss. So yes, $157 million is a really high fee, and not doing it as part of a written fee agreement, now we're talking a real possibility of some skullduggery. And the theories going around, I don't want to call them conspiracy theories, because what we've got are people investigating. Ron Wyden has investigated Jeffrey Epstein. He has found thousands of wire transfers that did not arouse suspicion within the banks. We know that skullduggery was going on with Jeffrey Epstein. We don't know how he made his money. It is an entirely legitimate, good faith inquiry to say, hey, was Lyon Black really paying this much money for advice on a tax strategy that's conventional enough that a firm like Paul Weiss is going to vet it and implement it, and the IRS is going to not pay attention to it. Because when you do a Grantor Retained Annuity Trust, you file gift tax returns. They're not income tax returns, gift tax returns. So the lead in here is much ado about nothing. The real potential investigation should be directed towards whether this money that went from Black to Epstein really was tax planning fees. But that's why this is of interest. That's why this is relevant to Lyon share viewers. Is you can read the news, and you can say, oh, Senate Finance Committee sent a letter to the IRS. Did you audit Epstein's taxes? Is it something that should concern me as a Lyon share viewer about when I do tax planning? So let's talk about that. There are many strategies, many tax strategies that clients will implement for themselves that do not involve audit risk. And let me clarify, that don't raise IRS red flag. They don't make it more likely that you would get audited, and they aren't illegitimate transactions. Meaning if the IRS does audit you and look at this transaction, they're going to say, okay, that's fine. This is something conventional. This is something we do. If you put money into a defined benefit pension plan or a 401k, that's not going to create an audit risk. And if the IRS sees that you put money into a retirement plan, they're not going to assume that there's anything they need to investigate. And most of the tax planning that we do in the tax planning space is very straightforward black letter law. It's legal, it's moral, it's ethical. We are going by the law. Now, there are some transactions that are higher risk. A lot of people who went to tax planners over the past 10 years were introduced to something called a conservation easement. Conservation easement strategy. That's a strategy that lets you buy into a partnership. The partnership would buy land at a discount and then put an easement on it. An easement is a restriction. So you might buy a golf course. The restriction is we are giving a legally binding promise to the local government or the local conservation agency that we will never develop this golf course. It will never be turned into houses or strip malls or office buildings or hotels or any of that stuff. And that's something that you can value. So when you create a conservation easement, if I own a golf course that's worth $10 million, it's surrounded by a suburb. If I were to develop that golf course, maybe it's worth $20 million. So if I give away that easement, I'm locking in the lower value. I can take a charitable deduction for that easement, right? So the strategy itself is legitimate. Some of the conservation easement sponsors got valuations that weren't realistic. So I bought a farm in the middle of Tennessee, and the highest best use is there's a subdivision, or there's a factory, or there's a hotel. And the appraiser says, oh, if you turn this into a hotel, you'll make $1 million a year from the hotel, and so the value you're giving away, but it's in the middle of nowhere. The land is in the middle of nowhere. There's no development anywhere nearby. There's the closest interstate is 50 miles away. And the closest business is a dive bar with a bunch of bikers there every night. And so the IRS looks at that transaction. They say, wait a minute, conservation easement is legitimate, but you're abusing the rules by coming up with this pie in the sky appraisal that isn't real. So we're going to shoot down this deduction that you took. So with conservation easements, like so many other things, right? It started out as a good idea. It's all fun and games until somebody loses it on. Started out as a great idea. A lot of investors wanted to get into conservation easements. The quality of the deals went down. And it finally got to the point where the IRS is literally auditing every single conservation easement partnership. Every one of them, done in the entire country during a certain period. And then finally, Congress said, we're going to close this down entirely, because the conservation easement deal was you put in $100,000, you're going to get a tax deduction for $400,000 or $500,000 or $600,000. And so Congress said, new rule, we're changing the rules, time out, changing midstream. The most you can deduct is $250,000 on your $100,000 gift. So that shut down the industry. The IRS says this is a transaction that can be used. They're auditing everyone. Does not mean that they're shooting down everyone. Just means that they're looking at everyone. If you can show that it's a good faith appraisal, you're going to be fine. And a lot of these are ending up in tax court. In some cases, the tax court is saying, we call shenanigans. That's a bogus valuation. In other cases, they're saying, okay, that's a reasonable valuation. So some of the strategies that we recommend in tax planning do carry those sorts of risks. And part of our job as tax planners is to sit down with those clients and say, look, here is a strategy. Here is the potential benefit. Here's the potential downside. One potential downside is this might be likelier to get audited. A second downside is if you do get audited and they shoot it down, you're going to owe tax plus interest and potential penalties. And then my client decides, do I want to take that risk? It's the same thing as an investment advisor saying you can go into bonds, you can be in life insurance, or here's this little stuff called microsplat, and it's $10 a share, and we think it might go to 100. Some people have a higher risk tolerance than others. People who buy Bitcoin have a risk tolerance. If you buy crypto, I said on the Neil Haley show on the Lyon share before, the only thing I know about crypto is you can't spell crypto without cry. So it's outside of my personal risk tolerance, but it's within plenty of others. And so the same thing applies to tax strategies as long as they are done in good faith with a reasonable belief that they are legitimate. A top law firm like Paul Wyden is not going to cheat IRS on Leon Black's behalf. That is very unlikely that they're going to do that for one client, because it's easy enough for the IRS to go in and say, okay, we're going to send you a subpoena. We want all of your clients. We want to know everyone you did this for. So it's a fun question for those of us who do tax planning, the Epstein situation, but we know what we do and we know where the line is. We know which strategies are plain vanilla and which strategies are out on the edge. And I would say that the Grantor Retained Annuity Trust strategy that Epstein recommended to Leon Black, that's much closer to plain vanilla than it is to going out on a limb, particularly when done by a firm like Paul Weiss that's going to be pretty conservative. They're not going to do anything if they're not confident that it's going to pass muster. Now, Paul Weiss doesn't care how much Jeffrey Epstein gets paid. They don't care whether Leon Black was genuinely paying millions of dollars for tax advice or whether he was being blackmailed. Paul Weiss didn't do anything wrong. The IRS did not do anything wrong by not auditing Epstein. Epstein is dead, but his is the gift that keeps on giving. And there are going to be stories about Epstein and claims about Epstein until the sun explodes, right?
All right. So very interesting. Check out and make sure you like and share the Lyon Share podcast. Appreciate it, Ed. Thanks again. And that was the special simulcast, the Neil Haley Show and the Lyon Share podcast, guys. Take care.